So I'm going to I've titled my talk Good Economics for the Post-COVID-19 Era, and I'm going to basically try to take some lessons of our recent book, Good Economics for Hard Time, to discuss how to think about the issues that are going to be ours to face in the decades to come. Because even once we have a vaccine, the COVID-19 crisis will not be finished because it will have major implication on poverty and inequality, both within each country and around the world. To start with, around the world, the GDP per capita of India has fallen 24%. Many other poor countries were hit hard by twin disasters, the health crisis, which in fact in developing countries has been a little less bad than what was originally feared. For example, the mortality from COVID in India is actually lower than what it is in most countries. Nobody understands fully why, but it's probably because it's a very young population. But still, there has been a health crisis with many cases. And second, there has been an economic crisis, which was induced by the health crisis itself. Overall, the COVID-19 pandemic is estimated to push an additional 88 million to 115 million people into extreme poverty this year, with the total rising to as many as 150 million by 2021. So this is going to be a major change compared to the trend that we have experienced in the last few years, where thankfully there has been a reduction in global poverty. In general, amidst quite scary geopolitical development around the world, the last 3 decades have been very good for the world's poor. Global poverty has been divided by 2. Infant mortality and maternal mortality have been divided by 2 as well. Most children are now in school. And so by and large, this is, since 1990, really a world where the poor and the poorest of the world were doing better and better. And the COVID-19 pandemic has changed that, at least in the short run and potentially for the much longer run. One thing that has been extremely disappointing at the beginning of this pandemic is the role of the richest countries in the OECD, which basically have done very, very little to go help the poor countries deal with the problem. The European Union, the US have been borrowing and spending vast amounts of money, trillions of dollars, to shore up their economy, which was the right thing to do. But as they did that, they couldn't find a little fraction of it to take care of the poorest countries in the world. And what this means is that what is probably going to be a temporary crisis with a swift rebound in the richest country might really become a much more durable crisis in developing countries, because what will follow the pandemic-induced coma in economic activity, if you will, is a more classical Keynesian demand crisis that will be induced by the fact that all the people who have lost their job during the crisis won't be able to consume properly. So this is the problem that we will have to face worldwide. Inside countries, this is also something which has been a pandemic which has been terribly unequal. At the beginning, there was this idea that, oh, the pandemic is a great equalizer. In fact, the few cases where people who had traveled, people who went to conferences. So initially, you had rich and poor people being sick. But overall, this is a pandemic which has struck the poorest people the hardest. So starting with health, for example, in the US, but you have similar numbers, similar statistics for Europe as well. Black and indigenous American experience far highest death toll from COVID-19. You can see here in green the death toll for the Black, and in yellow from indigenous, the fraction of reported by population, of course, compared to the white in black and the Asian in green. And this is not even adjusted for the population, the age of the population. So once you take age-adjusted numbers, the mortality of African American is 3 times as large as the mortality of white people. So this is for as far as the health is concerned. the economic burden has also been unequal. For high-wage workers, there was a steep recession in April and May, but it kind of quickly rebounded. So you can see here data from Opportunity Insights in Harvard, showing that the employment rate that dipped in April and May for the high-wage worker, people who make $60,000 a year, have basically completely rebounded, and by October, we are back to the February 1 level. But for the low-wage worker, the rebound was not nearly as complete, so that we are still at a decrease of 19% compared to pre-pandemic levels. And this comes on the heel of raising inequality in the US over the last several decades, stagnating wages over the last several decades. So this comes on the heel of a situation that were already vastly unequal. So people have made a lot of the fact that someone like Jeff Bezos, for example, became even vastly richer during the pandemic. But this is a little bit even beyond that, because it's not just the ultra-rich that are becoming richer. It's also, the merely rich that are doing well relative to the poor who are doing poor. And so the inequality are increasing at every place in the income distribution. So how to deal with this twin problem of an increase in worldwide inequality due to the pandemic and increase in within country inequality? So I want to briefly share with you 4 lessons from Good Economics for Hard Times and how they remain valid for harder times. And then I want to give you some very rapid thought about the case of Korea particularly, and how this relates to the New Deal in Korea. The first lesson is the critical importance of a legitimate government. So over the year, there has been a decline in trust in government worldwide. Also in Korea, by the way, where you can also see that in Korea, the trust in government is not that high compared to other OECD countries. The government is more distrusted than trusted. And this reached some particularly crazy extremes in the US, where you had, for example, a demonstration against the ACA, the Obamacare health insurance, with a motto like "Keep government out of my Medicare," keeping in mind that Medicare is a government program, so keeping government out of it doesn't make any sense. So how did we arrive at such extreme mistrust of the government? Well, part of the problem has a little bit been re-emphasized by economists and commentators and the media, which are quick to point out instances where the government has either been corrupt or inefficient. But what this forgets is that governments intervene precisely when the problems are too hard for the market to solve. And when you have markets trying to solve the same type of issues as the government, they are just equally corrupt. The COVID-19 crisis reminds us why we need government. First, we need government to have something like a mask mandate, to shut your business when the virus is too rampant, to do contact tracing like in Korea, because all of these have huge externalities and nobody really wants to do it for their own reasons. So unless everyone was completely motivated by altruism, which is not the case, you need a government to do that on behalf of society. You also need a government to coordinate the vast economic rescue package that have been put in place. You need governments to purchase vaccines and of course to invest in the research in vaccines and to certify which vaccines are trustworthy and which are not. So this really puts the government at the center of what is going on, but is really in a way a make or break moment, because a lot of people are upset with the restrictions. So unless they perceive the government as doing a very good job in fighting the pandemic, instead of creating more trust in government because we need them more, it could create more distrust because we see them more present in our lives than we are used to. And so you had big demonstration against restrictions, for example, in the US, but also in Europe, in Italy, in France, etc. And so I think we are kind of at a juncture where we could either go towards more trust, at least in the project of governing as a project, or even less trust, which would be extremely bad for our institutions. The second lesson from our book is that financial incentives are, in a sense, more than ever overrated. So what do I mean by that? Well, we often have the idea that people respond mostly to a reward, financial reward to do their work. So they work because the wages is higher. They're going to work less if the taxes are high, and they're going to work less if the government can assure them of their livelihood without working. So this is, for example, a debate that's been something that has been leveled against the idea of universal cash transfer program. In fact, when you're looking over the world, this is for poor countries. I'll show you something for rich country in a minute. Many poor countries have put in place a universal cash transfer program, not universal, but screened, but non-contributory. So people get this program if they are poor, regardless of their past labor supply work. And in many cases, these programs have been evaluated with randomized experiments. So you can see here examples from Honduras, Morocco, Mexico, Indonesia. And you can see the difference in the probability of having worked last week, depending on your whether you get the program or whether you don't get the program. And you can see that there is just no difference. So getting a sure income that ensure your livelihood doesn't make the poor lazy. But this is something that people have trouble believing. So in the 2018, we interviewed 10,000 Americans. We asked them a bunch of questions about the economy and their perception of the economy. One of the things we did is we asked half of our sample what they would do, for example, if there was a universal basic income, which you see in the top line here. And you can see that they all said that they will continue to work. Not all, but only about 10% of people said that they would stop working or looking for work. But the other half of the sample, we asked them, what would other people do if there was such a universal basic income? And they think, like half of them think that other people would stop working. And that is basically the big political difficulty, which is that even though people in reality are not sensitive to financial incentive, they tend to think that others are, which makes programs such as redistribution program, universal basic income programs, and of course taxation deeply unpopular, because you don't want to be the one person who working hard and is taxed away while other people are lazing about. And these ideas are very hard to root out. So for example, in the US, quickly after the pandemic, the response was to give people 600 weekly payment in unemployment insurance if they had lost their job. In Europe, we went for replacing the wages, which was probably a better idea, but at least here they initially gave people the unemployment insurance they needed. And from the very beginning, some senators, like here Chuck Grassley, said, well, you know, this is not a good idea. This discourages people from returning to work or taking a new job, delaying the recovery. By the time he said that, there was absolutely no evidence one way or the other. But subsequently, some evidence was marshaled. And you can see here a study from Yale looking at whether there is an effect of this $600 a week program, the CARES program, on employment. And what you're seeing is that in red, you have the regions where the replacement rate was the highest, where 600 was a lot of money compared to what they would have been making anyway. And in blue are the regions where the replacement rate was the lowest. And of course, people work less in places where the replacement rate is high, not because of the replacement rate, but that's because they are poor that the replacement rate is high. What is important is to see what happens after this dotted line where the program was introduced. Do people work less and less and less and less because they have the money available or not in the right places? And what you're seeing is exactly the opposite, which is in right places where the replacement rate was highest, you see a convergence towards the blue places. So if anything, the CARES program actually made people more likely to work than less likely to work. The reason being that it probably preserved the economy of the local places. It avoided a complete collapse of the places, and therefore people started getting back jobs. So I think it's more likely to be a labor demand effect than a labor supply effect. But all this says is that there is really no evidence to say that these programs make people lazy. But it did not matter. The Wall Street Journal titled when this study came about, this was economist versus common sense, saying, so the common sense, which is obviously true, is if you pay people not to work, fewer will work. And they, except at Yale. So they say, well, the economists are wrong and the common sense is right. Of course, there was about 10 studies on this, all showing the same thing, but this didn't matter. The Republicans didn't want to renew this program, and it was cancelled. And to this date, it's not back. It might be back with a new administration, but we'll have to see. The third lesson that we have in poor economics, and that's become even more true, is that the economy is not as flexible as we think it is. It is very sticky. So most economists in their model and most policymakers in their policies assume that people are quickly responsive to change in situation. So this is related to the idea that they are motivated mainly by wages. So if there is a problem somewhere, for example, if you lose your job making cars in one part of Korea because Korea is relatively expensive, you can move to another part of Korea and make robots, or you can move to another part of Korea and become a car salesman, because now there are many cars to be sold, and so there are many jobs in the car salesman sector. So that's kind of the idea, is that there is always churning and movement in the economy. But in reality, people move much less than they used to. This is for the US, where Tocqueville in the 18th century was marveling over how flexible the Americans were, that he talked about the restless American. And this may have been true then, but it's not true anymore. In fact, since the post-war era, mobility, both social and geographic, has diminished. And this is an example for geographic mobility, where you can see that in 1948, 6.4% of people moved out of their county every year, and by 2016, it's 3.9, almost halved. And this happened precisely when you had a lot of very big geographic shocks that were due to the trade with China. So precisely at the moment where people were hit by very important geographic shock, they found themselves unable or unwilling to move. And this has done a lot to make an entire region basically spiral into depression. Now, in the COVID-19 crisis has made this sticky economy stickier. Of course, the first thing that all the countries did is to close their borders, which had a huge ripple effect on international migration. But even internally, this was a disaster for migrants. So for example, you see here a photo from India, where essentially with 4 hours delay, the Prime Minister announced a complete lockdown of the economy. What this meant is that people who were migrants in cities lost at the same time their employment and their place of living, and also that any help that they could get from the government was tied to their place of origin. So if they wanted any help, they had to go home. So everybody was trying to get home at the same time when they had stopped the train, and it was a complete disaster. In fact, it made many more. It killed many more people than COVID at the beginning of the pandemic. And now these migrants are absolutely unwilling to go back again, even though the economy has reopened. Employers are looking for them, but they don't want the jobs. And so this will make it even worse to deal with the post-pandemic economic crisis. The fourth lesson is that throughout the world, what is more important to people than wages is dignity. And this is something that we're seeing very clearly in the US, which is, as we've seen this region spiraling into this economic depression, with it came a real depression as well, a mental health crisis, which people have called death of this culminated in what Anke and Angus didn't have called death of despair. Which are deaths coming from opioid overdose, from alcohol poisoning, from suicide. And what you can see is that since 2000, the map is becoming darker and darker, which illustrates the increased number of people who are dying from these causes. And this is so bad that even before the pandemic, mortality was actually rising in the US in the middle-aged population. This is something we had never seen since the flu. So even before the COVID-19 pandemic, there was a death of despair pandemic, and now the two are kind of on top of each other. And the death of despair pandemic is coming through the rise in inequality within the US. So now let me say, just to conclude, a few words about Korea, which is, what are my thoughts about Korea's response in light of what we know. So basically, there are 2 points to make. One is Korea is obsessed with growth. Professor Lee sometimes described it as growth addict. And this has been, of course, an ingredient of success until now. But there is one thing to keep in mind, which is growth is not important per se. What is important is welfare. And welfare is in part caused by a higher GDP, but in part caused by a good quality of life. You can see from the map I just showed you that in the US there is high GDP, but there is not very high quality of life if people decide to take their life away. When we have a lessons from the US and the UK in the early 1970s that we have to keep in mind. When growth slowed in the early 70s, and the first reaction was to assume that it was a problem to be fixed. And the way you fix this problem is by cutting taxes on the rich and welfare for the poor to give people incentive to work hard. And this did nothing for growth. Not surprisingly, we know very little about how to make rich countries grow faster. And we also know that people are not that sensitive to incentives anyway. But what it had is the first order effect that you would expect, which is inequality exploded with the unhappiness that we are seeing in the map I just showed you. Now, pre-pandemic, growth was slowing down in Korea. If you're looking at growth rate from 1960, there is a secular decline in growth rate, which makes perfect sense because it was a very poor country in 1960, so it had a lot of convergence to do. And now that it's a very rich economy, then there is less, easy low-hanging fruit to capture. So my point is that you shouldn't be too concerned about it because, well, it is slowing down for the right reasons, that there is less easy gains. But you are a very rich country. So now you should more be concerned about welfare and making sure that the welfare is equally shared and not be worrying so much about economic growth per se. And in this context, comes the Green New Deal in Korea, which has 3 pillars. The first one, of course, is the green aspect. And there, I would very much appreciate the leadership that the country is playing with a new administration in the US, with the Green New Deal in Europe. There is really a movement where we can do something about climate change. This is a photo of San Francisco during the fire that made the sky orange. I think this type of events do a little bit to make people more aware that there is climate change. I think the pandemic has made people more aware as well that sometimes nature is stronger than us. And this is a good moment to kind of try to assume leadership in the world and make the type of investments and policy decisions that are going to put us on a better track for climate change. So green investments are definitely a good part of it. The Korean New Deal is also a digital New Deal, so the idea of sharing the digital dividends. And there, I think we have to be extremely careful. We talked about inequality, both around the world and within countries. And what is clear is that digital revolution creates winners and losers. It's been so obvious during the pandemic, where you're seeing that if your job can be done remotely, mainly due to internet, the type of conferences we have today with Zoom, then you're not a loser, and you could be potentially a very big winner if you're Amazon, for example. But if your job cannot be done remotely, then you are in big trouble. And in particular, if your job can now be replaced by a robot, there's going to be a very strong incentive for firms to do it. They already had an incentive to do that before, but now with the pandemic, robots don't get sick, and if they can be piloted from home, then this is also something which becomes much more robust than to have workers in a factory. So what we can expect post-pandemic is an acceleration of automation in industry. And automation destroys jobs and creates inequality. You're seeing here during the Industrial Revolution, people destroying Luddites, destroying equipment. And people now make fun of them, but we have to remember that it took about a century for wages that declined during the first automation, during this period of automation, to go back to their normal level. So this could be the same with this new wave of automation, where there is absolutely no guarantee that the digital revolution will lead to an improvement in the welfare of the poorest, and it can in fact lead to a worsening because their jobs are the most fragile. So we need to make sure that we accompany that. In general, we've been very bad at compensating losers. We always hope that market forces will lead us to a new equilibrium naturally, but it's not always the case. Today, like in the industrial period, we are seeing that people lose their job from trade, from automation, and the compensation policy are completely inadequate. They are quantitatively much, much smaller than the losses people experience. And they also go with so many controls and so many obstacle to overcome that they destroy dignity in the process of helping out people. So this leads us to the last pillar, which is the human pillar, the social safety net. And there we need to keep in mind when thinking about this pillar that our social protection system are still worldwide. This is true in the US, in France, in China, in India, in Africa, everywhere. We are understanding social protection too much like charity. And like in the Victorian era, we want to make sure that it's not so comfortable to be poor. We want to make sure that people find it unpleasant to be in a poor house like here, and therefore they are not going to become lazy and stay with it for a long time. And our social protection system are to a large part still trying to do that. They are trying to exclude rather than to include. They are trying to make people understand that they should be generous, when in fact what they only think that is happening is that they are repaid for the cost they experience on behalf of all of us. So we really need to change this perspective. Government must be less worried of the undeserving poor, those who are not really poor, those who may not show enough willingness to work hard. Even during the pandemic, in the poor countries, it remained true that it was often very hard for the most affected to come and receive the help they wanted. And that creates a growing anger against the elites, which makes it impossible to solve the hardest problem we have to address. And in particular, I think it will become impossible to address the global issues such as worldwide poverty or climate change, which are connected, if we don't make within country an effort to have a more humane and respectful redistribution. Thank you very much for your attention. I will now stop sharing and be ready for the discussion.